Hi, and welcome to RJ Academy. To understand the economic health of a country, we first have to determine how to measure everything it produces. We can't simply add physical units, like 10,000 mobile phones and 5,000 tons of wheat. To get a total, we must convert these different goods into their aggregate monetary value. Our baseline is GDP at market price. Subtract depreciation, and gross becomes net. Add net factor income from abroad, and domestic becomes national. Finally, subtract net indirect taxes to change market price to factor cost, revealing actual production cost. Mastering these three specific adjustments allows you to calculate any of the 8 primary economic aggregates without memorizing separate formulas for each. Let's apply this to a single variable problem. To get from GDP at MP to NDP at MP, we only need to move from gross to net. By subtracting depreciation, the aggregate changes from gross to net domestic product. This process is how we identify domestic income. In macroeconomics, domestic income is formally known as NDP at FC. To find domestic income starting from our baseline GDP at MP, we use 2 rules at once. We subtract depreciation to reach the net value, and subtract net indirect taxes to move from market price to factor cost. If we use real numbers, it looks like this: 8,000 minus 600 for depreciation, then minus 700 for NIT. That gives us a domestic income of 6,700. These steps allow us to strip away market fluctuations and tax distortions to find the actual value of a country's manufacturing output. In many practical problems, you won't be given the clean variables for NIT or NFIA. You will have to calculate them from raw data points first. To find net indirect taxes, you take the indirect taxes and subtract the subsidies. If taxes are 180 and subsidies are 70, your NIT is 110. To find NFIA, you take the total income earned by your residents abroad and subtract the income earned by foreigners within your country. Now, try this calculation yourself. Find the national income, or NNP at FC, using these raw variables. Pause the video now and solve it before we move to the solution. To solve this, you first calculate NIT as 110 and NFIA as 60. Then, starting from GDP at MP, you subtract depreciation, add the NFIA, and subtract the NIT to reach the final national income. Manually calculating these components ensures you can work with raw financial data, even when a report doesn't provide a prepackaged total. Even with correct formulas, there is one logical error that can skew the results: the problem of double counting. If a farmer sells wheat for 100 rupees and a miller turns that wheat into flour sold for 150, we cannot add both numbers together. Since the 100 rupee cost of the wheat is already included in the price of the flour, adding both would mean counting the wheat twice. To prevent this, national income calculations only include the monetary value of final goods, excluding all intermediate goods and raw materials. Here is a summary of the 3 rules and the specific identities for domestic and national income. I've listed 2 practice problems on the screen. Solve them and leave your answers in the comments to check your work. Notes for this chapter are in the description. Catch you next time. By applying these specific arithmetic adjustments, you can isolate the exact type of income needed to measure a nation's performance.